Okay, I'm gonna have to wait till everybody sits down. And as you can tell, my voice is not doing well, so. What we're going to do now is we're going to have representatives of the Mortgage Bankers Association, National Association of Realtors, and the Appraisal Institute. They'll be up here by themselves with me for a while, and then we'll get the other guys here and we'll bat it around for the remainder of the program. I want to introduce Debra Stills. Debra Stills is President and Chief Executive Officer of Pulte Mortgage, a national lender that is headquartered in Englewood, Colorado. She's the Vice Chairman of the Mortgage Bankers Association, and she's been in the mortgage industry for some 30 years. Debra, we welcome you.
Thank you. Very much.
This is the first time that you've been with us, so
This is the first time. Thank you very much.
We also have Sara Stevens. Sara is the 2011-12 president of the Appraisal Institute, and she'll become president January 1st, 2012. She serves on the organization's board of directors and on its executive committee. Sara has been active as an Appraisal Institute chapter, regional, national levels for 20 years, and she's owner and principal of Richard A. Stevens and Associates, the oldest appraisal firm in Little Rock, Arkansas. Sara, welcome. Thank you. And please forgive me for cutting the introductions a little short. Actually, Bill, that thing you gave me is starting to work. What is that?
Don't
Bill's got, he had it on the bottom of his pocket, but it's still okay. All right. And also with us is Gary Thomas. Gary is the first vice president of the National Association of Realtors. He is a second generation real estate professional. He owns Evergreen Realty in Villa Park. He's been in the business for over 30 years and served the industry in countless roles. And one of the things that struck me is he has lots of grandkids. How many was that?
16.
13?
16.
16.
Oh my
Yeah.
gosh.
16.
That's good. I won.
Apparently his family has them so fast his bio can't keep up. It only said 14. Well, we're very glad to have all of you, and you're all new to our audience. So I guess just sort of in a casual way, in each of your areas, how is real estate doing? I'm just curious. You're in Colorado.
Yeah, I think we're a national company, so we do business in 29 states, wholly owned subsidiary of a home builder.
Okay.
And very pleased that real estate is stable and feels pretty flat. Even with some of the dramatic headlines that we've had in the last couple of months, our new orders and signups are pretty steady.
I'm just curious, how's cancellations? Is that a lot, or is that minimal?
You know, third quarter we might have been running around 22% can ratio.
That's a big improvement, though.
Mm-hmm.
Okay.
Yeah.
All right. And how about Little Rock?
Well, the Little Rock market is doing well.
Okay.
We are probably in the real estate, commercial real estate market. Our oversupply is apparent, especially in the office area. In the retail properties, our multifamily units are probably on an increase, and that business seems to be on an uptick.
Okay.
Our residential market is stable in some parts of the city, in some parts of the state, but in others, especially in the Delta, we see declines and real problems.
Okay. Gary, what about you live in Orange County?
Yes, Orange County has actually fared pretty well for Southern California. It's actually the best performing county in the Southern California area, and we're holding our own. I think we're doing fairly well.
Do you see any challenges with the loan reduction amounts? I'm just curious.
You know, we haven't so far, and that's
No,
surprised me.
don't happen
But
too
I
late.
think we will. Yes.
I think you probably will.
Oh yeah,
Okay.
especially along the coast where the average sale price is much higher, so it's going to have an effect there.
I hadn't intended to ask this, but if I was getting a $1 million loan, what would my down payment look like, and would I be able to be self-employed, or is that not likely?
Self-employed's pretty tough.
Okay.
It's tough to get a loan if you're self-employed.
And a down payment?
But down payment, you should still be able to get a 20% down.
Okay. That's better than I thought. Okay, let's talk about some of the legislation that they've dreamed up. And I almost have a hard time understanding the process. Dodd-Frank is a bill that has passed, is that correct?
Legislation passed about a year ago.
Okay. And yet, it's almost to be figured out later what it means. That's sort of what it feels like. So we're arm wrestling right now for the terms of what Dodd-Frank is, but it already passed a year ago. So what did they do? Did they say, this is what we want to have accomplished, find a way to get there? Or how does that work exactly?
Well, the Dodd-Frank Act has probably about 250 plus rules that need to be written, about 100 focused on mortgage lending. And so now the regulators are charged with actually writing the rules and the definition to meet the spirit of the law.
Okay. I know there's a lot of facets to it, but one of them is a qualified residential mortgage. So why is that maybe a problem for our industry? And everybody can pull.
Well, it's a problem because if in fact they adopt that rule, it would mean to get the better rate, you'd have to have a 20% down payment. And so, the problem with that thinking is, the thinking is that you have to have skin in the game. You have to have 20% down or it is not a performing loan. Well, your slides dispelled that in spades. But here's the thing. What they really need to concentrate on is the underwriting, not necessarily the down payment. If somebody can afford the payment, it doesn't matter whether they put 20% down or 10% down or 5% down. It's really, are they a qualified, buyer, and can they afford that property that they're buying? That went out the window, in the past, and now it's got to come back. But the down payment is not the critical point.
There's a thought that that's getting back to basics. And
yes.
I was wondering when those basics exist, because it wasn't true in my first house purchase, I know that, and that's a while ago.
Yours or mine. I bought FHA, my very first house.
Well, now, but that still exists under this, right? I mean, FHA is an exclusion.
Yeah, the risk retention rule is the rule that actually the definition of QRM comes up under.
Okay.
And the risk retention rule would say that a mortgage securitizer needs to retain 5% risk or reserve for the loans that they securitize. And when the rule was originally published, there was no exemption other than FHA, USDA, and VA. One of the things the mortgage bankers lobbied very hard for was this notion of a carve-out for a qualified residential mortgage. And the definition of a qualified residential mortgage was left to the regulators to write. The regulators put out the first definition of a qualified residential mortgage that required the 20% down, required 28/36 debt ratios, and required no late payments within the previous 24 months. And so that's what the industry's been reacting to is, did the regulators write a rule that was more conservative than the spirit of the law? Hundreds and hundreds of comments were filed. And I think, whether it's mortgage bankers or the realtors, the home builders, the consumer groups, I think on this one we're all aligned that the rule went too far, and we need to try again.
And the stated goal of this was encourage sound lending behaviors that reduce future defaults without harming responsible borrowers and lenders. And that's where the rub is that if it's 20% down in purchase or 30%, it's 30% equity for a refi. So that's a big chunk of equity.
Yeah, the mortgage bankers research would suggest, and there's a lot of research on this that folks submitted, but that if you look at the law provides for fully documented loans. Right. It provides for no negative amortization, no exotic loan programs like IOs or pay option arms. And so our research would suggest that the loan parameters inside the law were strong enough to prevent extraordinary default, and you don't need the other, what we would call underwriting restrictions. That normal protocol for underwriting should prevail.
Risk retention, for some reason that sounds almost like a good thing, and because somebody that's creating a loan would have skin in the game, but there's unintentional consequences. And what are those?
Well, I think what you've ended up doing is, if you think about the spirit of the regulation, it was to protect consumers, and yet the regulation has gone so far that it's probably denying credit to well-qualified borrowers. I think our statistics would show that you can get the right risk balance without going as far as the 20% down or the debt-to-income ratios. Our stats would show that if you look at the 2009 book of business, which was a pretty conservative underwriting year, still 70% of the consumers that got loans in 2009 would not qualify for a QRM loan.
Do we know what the difference would be in the interest rate of a non-QRM loan? Do we know what that might look like?
You know, we've heard modeling that goes all the way from 100 basis points to 300 basis points for a lender that would want to put capital reserves up and make a non-QRM loan. And that's the concern. Mortgage bankers won't have that kind of capital, and so there'll be too many of us that won't be making non-QRM loans.
Okay, but it would also eliminate a lot of buyers. If your interest rate was 1.5% higher, you'd have to eliminate a lot of people from the marketplace.
For sure.
And if it was necessary for safety, then I guess that would make sense. But if it's not, then maybe not. Something called reps and warranties, and I'm not in the mortgage business, but I know that's part of this bill as well. That basically means that I've represented my mortgage as being just exactly what you guys buy, and then something goes wrong with it, and I'm asked to rebuy it. Is that the general gist?
Yeah, if you look at probably one of the things that lenders are struggling with right now, and also, quite frankly, probably the primary driver of some of the behavior that you see from lenders in terms of conservative underwriting guidelines, it's this notion of reps and warrants. When we sell a mortgage in the secondary market, we make reps and warrants to the investor as to certain parameters. We are always on the hook for borrower misrep. We're always on the hook for not following the investor's underwriting guidelines and that kind of thing. And so as investors have gotten more and more conservative, and as loans have been put back to lenders, lenders are starting to get more and more conservative in today's environment, so that because we are on the hook for reps and warrants.
Okay. One of the parts of the law suggests that a third party do all of the reconfirming of verifications and so forth. Is that not already done? I mean, as far as underwriting, it says the law suggests a third party confirmation of how accurate the information is regarding employment, bank statements, et cetera. So is that done by other than a third party now?
Well, that probably gets to the stated income loans that the industry was doing in the past, and the fact that we didn't have a third party with a verification of employment or a verification of deposit or bank statements or whatever. So probably more addresses a fully documented loan. Okay.
Sara, the appraisal business has not been left out of Dodd-Frank, correct?
Certainly not. Certainly not.
But HVCC came first, and that did a fair amount of damage to the appraisal industry. So what changes happened with HVCC, and has that now been replaced with what's intended with Dodd-Frank?
Well, certainly one of the things that most real estate appraisers, especially people who were doing residential real estate appraisals, found was that a firewall was initially installed between the appraiser and the lender. And rather than communicating directly with the lender, the appraisers were then placed in a situation where they were directly communicating with a management system, a management company. And in many cases, our residential appraisers and the Appraisal Institute has surveyed and worked with them extensively, have lost 40 to 60% of their business, where they had a direct relationship with a lender, a client relationship, if you will. They suddenly were thrust into the idea that they had to communicate with a management company. And in many cases, rather than look for quality, for expertise, for education, for market expertise, the mantra became quick and cheap. And this is what so many of our people are facing now. We see people coming in from 250, 350, 400 miles away to make a residential appraisal, and in markets where they probably have very, very little expertise. This has been a real problem for us, and it's changed the face of the residential lending activity in a huge way.
I remember, I don't know if I said it off of the radio show, but I was thinking if I was an appraiser that had gone to sleep in 2007 and woke up in 2010, I would have been quite surprised at what happened.
You'd be in culture shock, I think.
Yeah, and you'd have your income divided by multiples, because you would have the assumption that you must be doing something crooked if you have a relationship, and you also now have to have a middle person taking half of your fee.
That's right.
And that would be very frustrating. Has the industry lost some of the people that would just say, you know what, I'm not interested in that anymore?
Absolutely. The statistics on renewal for our state certification requirements have seen that in some states that renewal rate is as low as 30 or 40% of what it had been before. And you know, just basically, just think about yourself. If you can't continue to support your family, doing what you're trained to do and what you have the expertise to do, then you have to look for something else. And that's what so many of our members have had to do. It's extremely difficult to retrain yourself to work in a lending environment where your expertise, your education, your qualifications really don't mean that much to the person or persons that you're communicating with. And that's unfortunate. It's unfortunate for the consumer, most especially.
We had an interesting appraisal that happened. I wasn't going to mention this, but it happened the opposite way, where someone with no experience in a very unusual area where you got a lot of money for a certain located lot, let's say. Well, there was a $1.3 million comp for the model match house, but they had the right location and we did not. And we had a home for sale for about $700,000 for 90 days, which would kind of give you an idea it's not worth 1.3. But when we went pending, the home was appraised for 1.3 million because it was a model match house, and somebody come in from out of the area, I think it was honestly Bakersfield, that didn't have a clue that that mattered there. And believe me, that locked in that sale though.
I guess you have to take it together, huh?
Yeah. Boy, what a deal. What's the intent? I mean, just like in the mortgage side of it, the intent seems to be, let's protect, okay, with the appraisal management company, what is their function, and are they really just supposed to make sure that appraisal independence is accomplished? Is that the idea?
I think that's the main function, and it was intended to be the main function. Unfortunately, I think it's become a clearinghouse for driving fees lower. Of course, that management company is going to make that money, and you know, what we find is that many consumers are confronted when they close a loan with an amount for an appraisal that includes not only the appraiser's fee, but also the management company fee. And sometimes the management company fee is more than what the appraiser is actually making on that particular sale. And I think I related to you a personal incident where I had a friend who called and asked me, is $100 the usual and customary fee in Little Rock for a residential appraisal? And I said, you know, it sounds a little high. Why don't you call that appraiser? And she did. And she found out that a good part of the fee that she was going to be paying for the appraisal was actually going to the management company and not to the appraiser. So this is huge.
What does the management company do to earn their cut?
Well, they engage the appraiser. appraiser.
Do we need one of those on here? That'd be fun.
They engage the appraiser, and they actually are responsible for the give and take, the documentation, securing the appraisal, getting the appraisal back to the file, getting it to the lender. So they're really a firewall, a middleman, so to speak.
So they take an email and forward it?
Yeah, probably.
Okay.
They hit send.
Okay. But they have to have expertise as appraisers, I'm sure.
Well, not necessarily. Not necessarily. In a lot of states, like in Arkansas, and I'm sure in California, you know, they have certain requirements for AMCs. The Appraisal Institute has been very, very active in trying to monitor the appraisal management companies and to try to get some kind of regulation process, some bonding, some kind of law that supports the appraiser in the event that there is some kind of argument with regard to fee, with regard to process. So, you know, in some states they're not regulated at all. In others they are closely regulated.
Now, that brings up a confusing situation. Do you have national and state regulations that overlap, contradict, and make it confusing?
Yes.
And you're in 30-some states?
We're in 29 states. We follow 29 states worth of appraisal regs, fees, forms, disclosures, predatory lending. The variation is pretty stunning.
At Dodd-Frank, I thought that they had tried to solve the reasonable fee, or what is the word? Reasonable fee.
Reasonable and customary.
Reasonable and customary fee. Has that changed in practice, where now the appraiser is getting paid what they used to?
No.
No.
That is still a huge issue. And when I testified before the Congressional Subcommittee in July, that's one of the things that I continue to talk about with that subcommittee. You know, the idea of reasonable and customary, I think the intent of Dodd-Frank was never to include the AMC fee in the reasonable and customary estimation.
No.
And the Appraisal Institute has done a lot of research and a lot of study, and we have looked at VA schedules and others to try to help these AMCs and to try to help the Congressional Subcommittee take a look at what a reasonable and customary fee might be to an appraiser. Our advocacy is that we would like to see that HUD 1 form simply separate those fees.
Sure.
And that the appraisal fee is on one line and one transparent number, and that the appraisal management fee be another. And certainly an appraiser needs to be paid for the time, the education, and professionalism that they have and that they bring to the experience. And the AMC should be compensated for the work that it's doing also.
Now, there's pretty severe fines for not paying reasonable fees, right?
It should be.
I mean, in the legislation, I mean, it gets
Yes,
into
it
the
was
millions.
Absolutely.
Has any of those fines ever been levied?
I'm not sure.
Okay. I wanted some juicy information on that. What about the usage of, well, I'll start with this one. Undue pressure. It certainly did exist, okay, and it's good that it doesn't. I get the feeling that undue pressure exists now on the back end. I feel like you have willing buyers saying, this is the house we want at the price we want it, and somewhere along the line there's pressure that it gets it to be less than that. And I don't know if it's the review appraisal process and an automated system, or it's an underwriter that says, let's just lower it. And I really don't know, but I know as a seller, I'm confused sometimes why it comes back less, and it's not reasonable, you know. The definition, you know, and I've had training as an appraiser, so, you know, I've got that definition down as far as somebody looking out for their own best interest. So a seller checks out the market and goes pending. To me, that's a comp. Now, if it disagrees with all the other comps severely, okay, that's maybe a problem. But when it really doesn't, and again, this comes back to the heart of our business. We fix houses, and we might spend $30,000, and we don't think, well, we automatically get 50 grand for that. But there's times where a buyer looks at that and says, well, first of all, we wouldn't be able to do it for 30, and a 20 grand price difference at 4% interest is so minimal per month that the answer is we'll take that over this one. And when you're 70% comps against REOs and short sales, and that's what's the problem. And I guess go back to, how are these reviewed? Because if someone doesn't show up and say, oh, this is a comp, but it doesn't have a kitchen, I mean, yeah, that's a problem. And you can't get the truth with a push of a button.
Right. And I think that points out the need for local market expertise, points out the need for people who are trained professionals, points out the need for people who are trained to go to the market, to interview the buyer and the seller, to investigate the comparables, and to make sure they are comparables. That's first. Secondly, I think that a lot of appraisers, as they begin to turn in their appraisal reports, face a lot of undue pressure, added comparables, for example, extra questions, more and more scrutiny placed on their valuation and their judgment.
And if they, let's say for some reason the pressure is there, or a review appraiser disagrees, could they lose business because they came in at a higher number than the review appraiser?
You know, I think that's probably something that might happen on some basis. But again, you know, it falls to the appraiser to defend himself over and over and over again.
Okay.
And if the information is there and the valuation has been done to the best of that appraiser's ability, you just get to the point in time where you just have to say, this is it. This is all I can do. Mm-hmm. And, you know, you have somebody, oftentimes, when that situation confronts us, we'll say, could I pick you up? Could we drive those comps? Could you take a look at them? A lot of times, you're talking to somebody who's sitting at a desk,
yes,
who never looks at that property,
exactly,
who never goes to that particular comparable, who never inspects the interior, who doesn't have any information about it. It's a communication problem sometimes, because as an appraiser and as a person who's writing that report, the communication still needs to be there to convey the extraordinary measures you may or may not have taken to include that sale and why. So, you know, it is a difficult environment, and it's very, very difficult sometimes to meet the requirements that are piled on, that are additional, and really seems to carve loose in terms of final valuation result.
You know, you do have underwriting guidelines, and you do have some investor overlays that are now causing some of this challenge where, you know, you might have an investor that requires that 2 comps be outside the community, and outside the community means possibly a foreclosure. This is one of the home builders' one of their top 4 issues is really getting a dialogue going as we see some of these submarkets starting to heal and prices starting to stabilize. And if you think about comps, they have to be closed, so you're always looking backwards. So how do we move forward? How do we recognize that in a declining area you might have a very stable submarket? And how do you recognize that some investors want you know, 4 comps or 6 comps, or justify the time, you know, valuation kind of thing? And so it becomes very complex when you combine both the appraiser's work and then an underwriter's work on top of it.
You know, I'll just give you an example of one, and it really changed our business model, so this is why it's significant to mention. We bought a property in Moreno Valley for $52,000, and it was without a kitchen and so forth, and we fixed it for $25,000, something like that. We put up for sale, went pending for $123,000, had 7 offers within 2 days. And that's a pretty good statement of market value. We apparently hit the number correctly. The appraisal came in 100, the review appraiser came in at 80. And so we consequently kept it as a rental at $1,100 and rented it in 1 day because it looked like that picture. The statement basically by the appraisal said that given $100,000 at 5%, that my rental payment was worth twice as much as the value when you consider what it was worth in mortgage payment. And that's an amazing statement. And what it prevented was us fixing the next 50 properties in Moreno Valley, because what it told us was due to the changes that HVC brought in, the appraiser was incapable of coming to that decision because no one would allow him to do it, even though the buyer said, yep. And that's the challenge for our industry right now, especially in those areas that have the overwhelming vacant REO as the comp. And we're trying to figure out how to do a service and get paid for it at the same time. So, any suggestions? More comps in the area, maybe. That's one of the reasons why we concentrate in an area, by the way.
Cash sales.
Well, because we provide our own evidence that decision has been made before, which is kind of what you're stuck with as an appraiser. You have to have evidence that somebody made that decision.
Right, and I think that one of the other things that points out is that a relationship with the purchaser and with the person who is going to be working with that mortgage, and some conversation and some dialogue on the front end certainly might help to solve some of those problems. You know, we're beginning to look at how we can develop some relationships in, as Debra said, submarkets that would allow us to try to take a look at what we have in the market we're working in. And I think that the technique, the theory, the ideas coming forward are pretty new. And, you know, they may have a lot of risk in them for a lot of lenders. And, you know, it goes back to educating both the lender, the appraiser, purchaser, the investor in what's going on in that market and how we can handle some of the consequences of the downturn that we've seen.
And I think that's one of the things that I think is difficult with HVCC. The spirit of the HVC was right on target. You know, not doing anything to exert undue influence on an appraiser. On the other hand, it's now law, and having those conversations, good, constructive conversations, are very delicate, and you have to be very careful and very thoughtful, and there's a protocol anymore to have an appropriate dialogue with an appraiser as you're trying to get to the right place. So that's where the law has made it. Again, we're still trying to figure out how to work collaboratively.
Yeah, it's viewed as coercion, and then it maybe could just be better information, and that would be good to know. When is an appraisal management company not necessary? Is there ever?
Well, sure.
Oh, I mean, I really don't know. In other words, when do they don't have to be in the middle?
We don't use an appraisal management
You don't
company.
ever use an appraisal management company. It's not forced on you on your lender. I guess that would make sense.
No, I think you have to be a reasonably large lender if you want to go direct to the independent appraiser, which our company does. We have a national subdivision processing department, so everything that has to do with property is done by a department that's outside of the origination, the processing, the underwriting, the closing. So as long as you can set up an arm's length environment, you don't have to use an AMC.
Okay.
Most companies, though, would use that as their way to ensure arm's length.
Right, and to stay within the law. And I think that's a big factor with a lot of lenders right now. They sure don't want to cross that line.
Okay. There's definitely a sense that there's some rotation system that's necessary. I've heard that said to us. Is that true? I mean, where it's just like no matter what the experience level or knowledge of an area, it's just that person's turn to get an appraisal?
We do a 1 in 5 rotation in every submarket. We probably have about 300 appraisers nationally that we use. So yeah, it's very important not to use one person solely for a community.
That would be viewed as
That
like a team partner or something?
All that appraiser's business would be dependent upon us giving, and so we have to do at least a 1 in 5 rotation is how we've set up our due diligence.
Okay. And you feel like all 5 of those are equally competent or they wouldn't be there? Or?
Oh, absolutely. I mean, we'll review the appraisals, we'll review for error, we'll review for any kind of quality control audits, and yeah, very much we would make sure that we've got qualified individuals on our appraiser panel.
And I think in that environment, probably you have more control over the quality of the appraiser. And that's one of the things that we don't find happening with a lot of the AMCs. They'll gravitate toward cheap and quick and possibly overlook the qualifications that the appraiser has, that local market expertise, which I said before is extremely important, really doesn't matter. It's the person who's willing to travel, to get that appraisal done, to turn it in. Maybe a quick turnaround time might be a day, day and a half. you know, there's no way that if you're not familiar with the market, you can march in, collect the comparables, talk with the buyers and the sellers, get a sense of what's going on in that market, make that inspection, get a feel for what that property contributes, what its overall attributes are in relationship to the others that are on the market or the other sales that have occurred. Go back, make that appraisal, write it, convey it, etc. in that quick time. Just can't do it.
It's hard to want to do that if you're getting paid half of the appraisal fee.
Sure.
It may not even be feasible to spend as much time because you just couldn't possibly do it.
Right. You might just go to multi-list and get a couple of comps and move on.
I think that's the appraiser we're getting. Yep. What's your feeling about broker price opinions? I'm sure this will raise some excitement.
Well, you know, one of the things about the broker price opinion is, in some instances, it might be a good vehicle. But for mortgage lending purposes, for decisions that a lender has to make, by and large, those opinions are unregulated. You know, an appraisal that is put forth and signed by a state certified appraiser has some education. We're unbiased. We're a third party out there taking a look at the property. We really don't have anything more in the game than just to report and analyze that market. And sometimes I don't think that in terms of a broker price opinion, you have that disinterested person. They're an advocate for the property owner, for another entity, and certainly not regulated like the appraiser is in terms of adherence to USPAP, adherence to certain educational requirements. There's so many things that are missing. And the broker price opinion might have its place in some part of the real estate picture, but certainly not in terms of making a decision to buy or sell. And you know, it's a difference. It's a different approach, it's a different mindset, it's a different thought, and it should be for a different use.
It seems like when there's an REO created now that there's a series of things that happen, including both of that, a couple of BPOs and an appraisal.
Yes.
I'm not sure which one they weigh heavier or not, but there's evidence that everybody's getting a turn at saying what the value is. Do you see anything in Dodd-Frank or the changes in qualified mortgage that threaten a 30-year mortgage for some of the stratuses of loans? I'm just curious if we're going to have the supply of money that wants to go out that long.
Yeah, I don't probably see anything in the QM or the QRM that would specifically attack the 30-year mortgage. I think for the most part that's certainly been a product that this housing in America has depended on for many, many, many years. And I don't personally worry about the 30-year mortgage going away as a result of the regulation.
Okay. Is there any discussion about where Fannie and Freddie will end up? Of course, I'm going to get some more opinions on that, but is there any concern that they're going to be smaller by quite a bit?
Yeah, I think our fragile housing market right now is delaying certainly the government's desire to shrink the footprint in housing. The white paper at the beginning of this year would put forth, pretty much launch the debate for the future of the government's role in housing, the future of the GSEs, and how to rebuild the nation's secondary mortgage markets. I don't think probably the debate is really going to get going until maybe after the elections. So I think the future of the GSEs, there's a couple of bills that have been introduced that would suggest, all the way from totally privatizing what would now be Fannie and Freddie to maybe private companies with a government wrap for the securities that are issued. But debate probably won't start until the end of next year.
Okay. Why don't we go ahead and have our other three panelists come on up, and we will start another train of questions. Oh, we got all kinds of good stuff for. Actually, Bill's thing was pretty good. Oh, now we got a fistful. No, I don't like that.
Good job. Yeah.
Okay.
You got it easy.
No kidding.
We've got some of the troublemakers back, but my voice is going. All right. One of the things I read recently was a Moody's report that talked about with the qualified residential mortgage in place, and it referred to FHA as probably only being 10% of the market. And that really surprised me because almost I'd say in California, even on the low side, first-time buyers are 30%, and the high side 50% in a market like now. How could FHA be only 10% unless it was really being restricted?
In the future.
Yeah. So I guess that's what I was wondering. What would be the restriction to prevent that from being a normal percentage? Because that would be the loan you would think those people would go to.
Yeah, I think, if you look at what the government's willing to do to get FHA from a 30-something% market share down to maybe a target of 10 to 15%, they've already raised the mortgage insurance premiums, so an FHA loan is slightly more expensive than it was. We've just seen the stimulus loan limits expire, and so there's another little nudge toward a smaller market share. There's been talk about, maybe looking at a median income restriction somewhere in our future. I don't think we're going to see any of that anytime soon, but I think we're going to see small moves to get that market share down from about 30-something%.
I think it'll be part of the discussion of getting the private market more involved. If you go back to some of the history of the FHA loans, the underlying theory for FHA was that there was a part of the credit spectrum that wouldn't get served by the private market because the returns probably didn't reach private market returns, and that there were external benefits from encouraging home ownership by providing a subsidy through the FHA program to get credit to those households. But in return for that, there was also a ceiling on the size of loan that was available in the market. So you may also see some discussion of that come up again. But I think it will all be done in context of what they do with Fannie Mae and Freddie Mac.
Right. How big of a deal do you think lowering the loan balance is? We asked that before, but I've got to, just from the numbers that I know, for instance, in California, we had a median price of $600,000. We now have a median price of under $3 million. And even though they reduced the loan limit, it has to serve more households with the new loan limit than it served at the big loan limit because there's a lot less expensive homes, at least going forward. Now, you might have a problem with refis. I could see that being a problem, but I don't know that, are we supposed to have a government program that's over twice the median price of an area? That probably is not true.
If you look in our book of business between the previous limit and the conforming limit to where it dropped, it was less than 5% of our book. The problem is it's regionally targeted, right? So California is going to get New Jersey, places like that.
Maryland, Washington, your high-cost markets are obviously hit more than the national. We modeled our business, and the impact is very small. Although you got to question anything right now that would be negative to housing. Is that what we really want to be doing?
Just on the loan limits thing, one of the things that always, I find interesting about these federal programs, right, is it's at the county level. And one of the biggest drops that we had here in California was in Monterey County, where you have Watsonville that's pretty close to, Carmel, Pebble Beach, and Monterey. And these are two completely different markets, even though they're, 15 miles apart. And so Monterey and Carmel are going to take a $200,000 hit on the conforming loan limit, Whereas, areas in San Jose and Contra Costa County and those areas that aren't as desirable aren't going to take as big a hit. It makes no sense.
That's a true statement. I hadn't really thought about that. That happens every place that they make that decision. Like in Orange County, that would be probably not a factor in Santa Ana.
Right.
But it'd be a factor in Newport Beach.
In Newport Beach it is, that's right.
Yeah.
That goes back to that comment that we made earlier about applying a broad-based national policy to anything. It overrides all of the local conditions that require some of the expertise that was being talked about in the appraisal space and a whole host of other things that relate to real estate. For a long time period, we looked at the national house price, and then we talked to our friends and neighbors about all real estate is local.
Mm-hmm.
There's that document that talks about let's try to save whatever it is, $2 trillion or $4 trillion off of the budget going forward. And real estate would obviously be a natural target for trying to get some of our chips. And so is that something that is, I don't know, have we thought about what might be okay to take, or are we going to go, can't have any of it? I asked that of this group, by the way. We had a questionnaire, and I would say a good half said it's not okay to take any of it. But I wonder if it's not going to happen one way or the other. So which of the, like an interest rate deduction, going down to $500,000, is that impactful, do you think, to our market?
Well, we think it is. National Association of Realtors does.
Okay.
We do not think that should be touched at all. And because of the unintended consequences, no matter where you go, one of the proposals is you do it on second homes in resort markets. Well, what does that do to the resort market, and what does it do to those communities where you can't resell properties? And, the unintended consequences is, it affects the grocery store, it affects the pharmacist, it affects everybody. It doesn't just affect the person that owns that property and can't deduct it anymore. So,
well, I agree with Bruce. It's a real target because frankly it's a government subsidy, and subsidies on both ideological camps are obvious targets for cuts. And of course, it's always the other guy's subsidy that's the bad one, not your own.
That's right.
So, I think that it's likely to happen. I'm not sure if it would have as big an impact as everyone thinks it would. I think the real big problem we have right now is, incomes and employment. I mean, we're not really going to fix the housing problem. All these are marginal issues and are marginal solutions until we start having job growth.
Well, why don't we talk about that, because you and I talked a little bit about it over lunch. Riverside County is 15% unemployment, and usually we really count on construction.
that's right.
But we have a price per square foot on some inventory that's half of construction cost. So it's like the dominoes almost have to fall backwards before they can fall forward. We have to get rid of a lot of what we would consider shadow inventory. So why don't we start there? Let's talk about shadow inventory and see if we're on the same page of what it is and what to do about it, because I think until you end up with that disseminated into the marketplace to where no one fears it coming out later at below replacement cost, then you can finally go forward. So, Sean, I'm going to ask you, because you get to talk about shadow inventory probably a lot. What's the newest version of what it is? Because it has changed.
Well, I think it moves to help provide cover for whoever got it wrong the first time. It started out, when we first started talking about it, was in 2008, and you had foreclosures just on a tear, banks taking back lots of property, and we weren't seeing that property back on the market. And it occurred to us, wow, the banks are really holding a lot of property that's not making it through to the market. And so that's what we talked about originally is shadow inventory, and we had some early stats on that. And then a lot of people, talking about the foreclosure wave and other things, needed to change that over time. And it's grown to then include everyone in foreclosure. Okay, that makes sense. Everyone who's delinquent, okay. everyone that's in negative equity. And I've heard others say, well, it also includes all those who would like to sell at the prices that are in 2006, but now can't. You know, so
Every
I
house
mean,
in America.
So it's everybody that
That's
owns.
the delusion inventory.
yeah, that's the delusional inventory. Yes, that's a good. I love that, Eric. And but make no mistake about it. I mean, start talking to folks, start talking to your neighbors. There is a lot of delusional inventory.
Oh, yeah.
Yeah, that's right.
There's a
Huge.
lot of property that should be and would be on the market if people weren't still holding out some hope that there's going to be some fix in Washington. And I think that's as big a problem as anything else.
Well, I mean, I think, for instance, in some markets, you have 3,000 square foot houses that cost a lot to build, being bought for 140,000. And there might be a pile of them. So that shadow inventory is not just what the lender owns, it's what's being refused to be foreclosed on. At least that's where I would go with shadow inventory, is this ball of 2-year late people that for whatever reason aren't being forced to the finish line. Now, give some credit to MERS or robo-signing or whatever, but long before that became a front line issue, it looks like lenders made a decision, let's just don't foreclose on that. So what's the reasoning behind waiting so long, if that's a fair question?
Why
I'm not asking directly.
why is there some people waiting for
Why
prices to
are
return to
lenders-
normal?
Yeah,
like
well, as a matter of
2006?
fact,
Why are the lenders not
let me just
waiting?
say one other thing before, is that the last time we had this problem was in the 90s. And lenders started to wait, and people were getting close to a year behind. And the FDIC came over the top and said, And I remember the chart, because I'm really connected to charts, and you had foreclosures decline in 95 in California, and yet delinquencies went up. And there was a rule passed that when you're 100 days late, you have to file an NOD. And that came basically from instruction. And this time, it seems like not only wasn't there an instruction, there was like a free pass and just say whenever you want to, or if you don't want to, it's okay. So what changed and why is that?
Well, isn't it largely because there's not a large enough pool of creditworthy buyers by the new definition of creditworthy?
Well, I would say that if you wanted to sell it to investors, you would have all you could give to the market. Yeah. But I don't know that that's the reason. I don't think that there's a fear that there's not enough cash even, because how much gets bought at trustee sales every month? It's a lot of money.
I don't get the sense that lenders are delaying foreclosure by design as much as working through the process, meeting regulations, meeting investor requirements, state requirements, et cetera, unless there's REOs that they haven't put back out on the market. I don't get the sense that lenders are purposely delaying the foreclosure process. By the same token, I think lenders are going overboard right now to make sure they're doing the responsible loss mitigation activities that they need to do to help keep borrowers in their homes or structure short sales or whatever the appropriate process is, one buyer at a time.
I think they're also trying to figure out who owns the loan.
I mean, honestly, we had more than double the foreclosures that we have today in 2008. So this idea, this notion that the lenders need more time to figure this out is, it's ridiculous, right? Just on its face, flat out ridiculous. They've had plenty of time to figure it out. We're 4 years into this thing, right? That's not the problem. I think Doug touched on it earlier when he said, look, at Fannie and Freddie, we're really, we don't really want to talk about principal balance reductions. We're worried about foreclosures because ultimately these losses, flow through to the taxpayer. And the taxpayer is not really in much position, to take them right now. And so, I mean, it's really clear to me, and neither are the banks. I mean, you start looking at just the seconds that a bank has that are, maybe the firsts are held by Fannie and Freddie, but they've got this portfolio of seconds that are on their portfolio, right, that exceed the equity of the institution. So you really start clearing this stuff through, you've got a much different problem than, just simply processing the paperwork. You're talking about national, certainly banking and government solvency.
Yeah, in some sense, it's a grand social experiment of the question, would the welfare of the economy and the populace be better served by a rapid and deep clearing of inventory, which would bring into question the solvency of a significant part of the financial system, or do you get a better result through a variety of policies to make a slow move to bring prices back into equilibrium? There's basically an experiment underway to test that.
And I think that would be great, except right now it's extend and pretend, because, take that, say, hey, look, we've got more losses here than we can afford to bear, right? Fess up with the American people that that's really the situation, and we're going to, on purpose, drag this out so that we have an orderly, dissolution like in Greece, right? Rather than a disorderly one. And I think the longer we continue to extend and pretend and not have a conversation about how bad it really is. We created $4 trillion of excess mortgage debt. We've worked through $500 billion of it so far. We've got $3.5 trillion to go. We can't afford it today. And so we've got to have a different solution.
One of the things that I do a lot of studying of charts, and so one of the things that I noticed that in 08, when we really had a lot of price damage, when I was buying houses for 18 cents on what the lender was owed, that was really the number because there was so much inventory. At that time, our defaults was, say, 3.4%, and our foreclosures were 1.2%. About 9 months later, our defaults were 11%, and our foreclosures were 0.08. And they just stopped foreclosing. You had triple the default. And one of the disservices it does is there's gentlemen in this audience at the time of 08 had 800 REO listings and had a business plan around that volume and was never told that was going to turn into 200. And that's one of the things that would have been helpful, is to tell an industry, we just simply won't do this at this pace anymore, and they could have had a better business plan. That is one thing that would be frustrating, because mortgage people too, or appraisals too. I mean, that's all business that's churning in that red ball behind us that's not producing a fee or a commission or a rental. And I think that's one of the things that we might surprise, especially if you could put deed restrictions on, and maybe you're right. By the way, those losses that are, I'm talking about what you just mentioned, in second position behind a first that's a 200% loan to value, is that being booked as zero value, or is that being booked at face note value? I'm just curious. Anybody know?
Well, I mean, back in 2008, when Paulson announced TARP, everybody thought it was about loans to banks. But if you go back and read his statement, it was really about, we shouldn't force these banks to sell these properties into this distressed market at these distressed prices. And that sounded good on paper, except this wasn't a distressed price. This was a reversion to the mean. This is the price that things were supposed to be at. And these losses are real, and we need to figure out how we recognize them and deal with them. And 4 years later, we haven't even started having an honest discussion about recognizing them and dealing with them.
Well, I mean, what would happen if we said, okay, let's foreclose on that red ball? Is that, do you absorb $4 million and survive?
Trillion?
I say 4 I'm not a big thinker, I guess.
I think, Doug may be right. Maybe we, need to think about a different social, experiment, but let's have that conversation. I mean, at the end of the day, what we need is a clear housing policy, because I think most people realize that extend and pretend's not working, and that's one of the reasons we're not seeing home sales take off in Riverside, where it's now, an incredible bargain.
I think it's hard to...
Historic terms.
It's hard to take risk when you don't know the rules of the game.
Well, you certainly have a lot of uncertainty in the lending community right now, waiting for regulation, waiting to understand the government's role, so that there is a lot of uncertainty in that regard. I think, well, go ahead, Doug.
I was going to say just a clue about what the population is thinking. As I mentioned before, we've been surveying 1,000 people a month for 16 months. So we get, and it's available on our website. You can see we publish it the 7th.
It's a good report. I read it.
Yeah, and so we ask them about their expectation on interest rates, on prices, all these things. But in the most recent quarter, we also asked them what they thought about the stability of their employment, to go back to the question of employment. And 26% of the people who were employed were worried about being able to stay employed. And then 9% of the people in the workforce are already unemployed. So you have over a third of the workforce that is concerned about the base ability to pay anything. So when you look at their expectation that interest rates are going to be essentially flat for the next 2 years, they expect house prices to fall during that time period. They're essentially asking, why would you tell us that now is a good time to go out and borrow $200,000 and buy a house? So there's a lot of discussion about maybe not the principal forgiveness, but the HARP program, the Home Affordable Refinance Program, and why people aren't taking up that. Well, if you think the practical aspect of the household, what the household faces, they're asked to bring $4,000 or $6,000 to the table. If they're worried about being employed in 6 months, they're saying, if the payback is $200 a month in savings, it's a couple of years before I get that money back, and maybe in 6 months I won't have a job. So if you say, well, okay, well, I understand that, that makes sense, let's roll that into the principal. They say, but look, I'm already over-leveraged, I'm trying to de-leverage, and now you're suggesting I should take on additional leverage. That doesn't sound like a very good deal either. So there are, at the end of the day, for me, equally big to this supply of properties that has to work off is the question of stabilizing people's employment. That's as much a macroeconomic issue, to Deb's point about the uncertainty, as it is about housing. Because the engine for job growth is small business, a part of which is construction, to be sure. But when small businesses are surveyed, the number one reason they say they're not hiring people is lack of sales. Number two is uncertainty about the tax and regulatory environment. So I think until macro policymakers get back to focusing on what makes a good investment market for businesses to go into and hire people, I think we're going to have a concentric circle between housing and that problem. That means reduce regulation, stop making every tax code have to be renewed every 2 years, make some permanent decisions on whether you're going to advantage or disadvantage investment, so that entrepreneurs have a clear view on whether they're going to be able to retain the capital gains that they make by investing in their business. Those kind of things have to be put in place to give a strong investment environment, which will then lead to employment. And then people will buy houses.
I have to reinforce Doug's point. We have a general problem with underinvestment in our economy.
Underinvestment?
I mean, there's not enough capital going into investment versus consumption.
Okay.
And the result of that is that we're not planting seed corn, and that includes in the housing market, but it's also true in my industry, in venture capital. There's a precipitous drop-off in investment in early stage companies, which are the companies that provide most of the jobs and all the growth, and also all the exports and all the other good things that come with it. It really comes down to what Doug was mentioning. We have to we have to make investment decisions very clear and stop disadvantaging investment.
What's the likelihood of that happening inside of the next year? Is this a bad year for those decisions to be made?
Not going to happen.
I don't think anything. I think the safest bet you can make is nothing's going to happen in the next year there.
You wouldn't get a better return on a bet on that than you would in investing in a house.
What is the feeling of, and I did talk to you about this in the limo coming over here, what is the general sense of what's standing in the way of letting the investors participate more fully in taking the inventory down? There were in times in the past where we had that, we had a 203K loan program that was available. And we had more generous loans available to investors. And, you know, I can understand I interviewed somebody from FHA, and that ended in about 95, and I said, why did it end? We said, well, we didn't need you anymore. So we're ready to be used again, I guess what I'm telling you. If you could just use us for 3 years at this interest rate, we would hug you for the rest of our life.
Well, the Mortgage Bankers Association supports relooking at the 203K program, maybe with some incremental safeguards versus the program before, but we would support that also to clear some of this inventory.
Well, that would be, I think that would take care of like one level of it, but there are people here that probably wouldn't want to go through the journey of that loan, but would buy something as a rental and keep it for a long time and do it in pretty good sized quantity. And it seems like that red churning ball is a big quantity. Is there any discussion about a deed restriction to where I think if you gave us financing, we would probably say we won't sell it for 5 years or whatever. Give us the number of years you want us to hold on to it. We'd probably be okay with that.
That was one of the recommendations on the RFI that the MBA made was, as it related to some of the bulk sales, would be possibly a hold provision, maybe a 3 to 5 year hold provision. But yeah, I think, you know, I think one of the things we have to consider is moving this inventory, the overhang, and we're going to need to look at investors to do that.
Well, now, when you say bulk, you're talking about, are you talking about 20 houses or 2,000 houses? Because that's a very different animal.
Yeah, probably more than 20, less than 2,000, but I'm not sure we have a definition.
Well, I guess I'm wondering if the person that buys 20, they're going to fix those up, and they're going to keep those. A company that buys 1,000 will probably try to make it livable, but I don't know that that's as helpful as making it nice.
Right.
You know, and so that's a different animal. I think, and I think the future too. I think, okay, in a way we have a chance. That's why the nothing down program intrigues me. Right now you have a chance to get people in at a very safe payment that's fixed. Later on, when we have to pay more taxes, which we will have room in our budget because that payment will seem like a car payment. Mm-hmm. But if you don't let people in, their rent payment is always going to approximate market because we'll make sure of that, right? I mean, we're not going to give somebody a 30-year fixed rent rate. And so it's really smart to say, okay, and that would be supportive of price too, in my way of thinking. If you had people buying something at no down at 4%, I think eventually you'd have price support and you'd get rid of the inventory. Now, Sean, of what you're saying is, if we could sell every house tomorrow at full market value, that would crash the system?
I think so.
Okay. Well, I'm glad you're here tonight. I don't know what to do with that. In other words, we really can't.
It'd be a better question, you know, for Doug. I believe that, but I think, you know, Doug or Eric might have a little better view.
Well, I think, to me, the big picture problem here is that at the end of the day, someone will not get paid.
Okay.
I mean, there's just no way to avoid, it's just like the Greece situation. Someone will not get paid. The political system is good at doling out benefits. It's poor at doling out costs. And so a lot of what's being done is, instead of the broad-based principal write-downs, that's something that could fix a whole bunch of problems. But you face adverse selection, an unfair distribution of results based on decisions made in households. Taxpayers are going to pick up a piece of that. So it's costly politically in addition to financially. There are some discussions of things which are small costs. So, for example, some ideas have been floated about tax forgiveness for investors who would say get a 3-year abatement of taxes on the rents that they receive if they were to invest in a property today. What that does is raise the rate of return to them, which raises the bid price that they could be willing to put into the market and reduce losses perhaps to the institution which holds the loan today. There's still a loss, but it's incremental, it's not as visible, it's actually moving some of the inventory. So I think you're going to see a lot of program proposals
Capital
like
gains
that.
relief.
Capital gains release.
And I think all of it might be unnecessary. In other words, if you would just give us financing, we'd buy the heck out of it without all those goodies, honestly.
Well, and those are some of the recommendations. Fannie and Freddie looking at investor properties, investors that could own more than, what's the limit, 10 right now? Yep. You know, those, it's small, incremental improvements to the HARP program that might allow for higher LTVs or other, you know, loans after 2009. There's a lot of things on the list. As Doug said, principal write-downs is very challenging, certainly for mortgage lenders. Is the taxpayer going to pay? Is the bank going to pay? Is the investor going to pay? As you say, somebody's going to pay that bill.
Yeah. What about the idea of refinancing owner-occupant or investor over-encumbered mortgage? Why not refi them at the current rate, whatever the LTV is? You got the loan anyway. Why not make it make sense, and they go, okay, well, now I can write it out.
Without an appraisal?
Well, appraise it, so what?
It's underwater.
Well, it's underwater, but at least you might know how much, but it doesn't matter, you're already there.
Right.
What's the point of having a 6% mortgage that's not getting paid when you could have a 3.5% that would?
You know,
I think that's part of the discussion.
Yeah. But one of the things that, I mean, that is on the list to talk about,
really?
Certainly. And yes, and
when it comes up, can I come over
yes.
to that?
One of the things that we need to consider too is if you think about the capacity of the industry and the fact that the large depositories have a good portion of these properties, it would take the whole industry to participate to help move this big elephant through the system. And most lenders that don't already own the mortgage are going to want rep and warrant relief, right back to those rep and warrants. Why would a lender who doesn't already own an underwater property or a loan on an underwater property want to do that deal unless they got some kind of rep and warrant relief? So that's a big deal for part of the discussion.
Okay. What about the idea I just floated out there a little while ago about principal-only payments for a while to get people back to a level of even? Is that sensible at all?
Well, if the loan's in a security, then the servicer has to advance principal and interest to the investor. So as you were talking about principal only, that's still going to create a negative gap for whoever the servicer is because they're advancing to the investor principal and interest each month.
Right. Well, the investor, can he make, say, a new agreement and say, I realize I'm about to take $150,000 loss if this doesn't get paid, so why don't we do this instead? Is that a side agreement can be made or not?
Yeah, I don't think there's anything that prevents two private parties who have a contract from reworking that contract.
Okay.
I think there's no inhibition there.
Yeah.
Does it start to trigger some CDO risk and other things, though?
Well, it depends on the structure
and stuff.
right?
Yeah. So I mean, and then does that come back to this bigger, picture thing? There's, they talk about the derivative risk because the derivative risk isn't, it's I know you're a pyro, and so I take insurance out on your house, and so do 20 other people, and so you start talking about magnifying, these losses potentially, right? And we still don't know what that is. I mean, we realized this is a problem, years ago, and they still haven't even gone in and tried to figure out how big the derivative risk is and where it lies. We don't have no idea.
And you got to wonder what you do to mortgage liquidity if investors are have to take the principal write-downs and who's going to invest in mortgage-backed securities in the future, and what do you do to the future liquidity of the industry with some of these dramatic, actions, if you will?
Well, if you look at the market data, that market's pretty moribund as it is, right?
Yeah.
It's been continuing to decline. It spiked from about 300 billion to 1.2 billion. Last I checked, was back down to about 400. So it's, and you can exactly identify the point at which that market started to fall in the financial crisis, right? That market's probably not coming back for a long time anyway until there's market clearing. There's also a hidden additional cost in forcing homeowners to pay mortgages against inflated home prices, which is that there is a stream of payments that is going uneconomically to a home price that it really shouldn't have existed in the first place. So personal consumption expenditures are getting absorbed for this non-productive, non-economic purpose.
As you can see, we have 7 minutes. We have 6 people. I'm going to ask you, we'll just go down the line from Debra down. If we get together a year from now, what's the one thing you'd like to have accomplished for your industry?
For me, I would like for all mortgage lenders to work collaboratively with each other. If you think about our industry, we've got large depositories, we've got small community banks, we've got independent mortgage bankers, brokers, etc. We need to work collaboratively with one voice. We need to decide on a way forward and not be fighting each other. And then I think, too, we need to work collaboratively with the regulators and the policymakers. Make sure that we don't overcorrect. Make sure that our regulators understand the unintended consequences of this massive amount of regulation, and make sure that we end up in the right place 1 year from now with some of all of this regulatory environment.
I would agree with that, and I think a great deal of it is overkill based on evidence that the market is simply adjusting back to what is a sustainable homeownership rate anyway, and underwriting standards have moved back to more traditional levels, and I think part of that is, part of the solution is in the room here. I think that if the homeownership rate is going to be lower, then by definition, the investor and rental share has to be higher. And I think that's why there is finally a turn to focus on what are some ways that can be advantaged.
And we really appreciate your attitude toward helping us get there. We really do.
It's reality.
Sarah?
Well, agreeing with what's already been said from the appraisal side, I certainly think that one of the most important things going forward, and one of the things that I certainly would like to see happen and be a result coming forward into 2012, is a real effort on the part of lenders and the people who regulate the appraisal business to take a look at the difference between an appraiser and a qualified appraiser. That difference is huge. And to take a look at the expertise and the education that one has as compared to a person who is just simply earning a fee. I think that working with the Appraisal Institute and with other professional organizations certainly would be important, and we, the Appraisal Institute, would certainly like to work with the lending community, the brokers, all of those who are involved in the mortgage lending process to make an effort to use the most qualified people to give the most reliable valuations that we can.
Okay. Sean?
I'm going to go for a stretch goal here. I'd like to change the national discussion on what a home is worth. I think this whole concept that a home is worth what the last 3 idiots were willing to pay, or what the last 3 pieces of trash REO were, and this isn't to pick on appraisers at all, but the sales comparable approach to appraisal versus income or cost basis or other things, I think is ridiculous. It wasn't certainly the cause of the problem, but I think it didn't help keep that problem from getting out of control. And I think we have a poor understanding nationally of what a home or a piece of real estate, residential real estate, is really worth.
Well, you and I have talked about this privately, and that's, if you think about the appraisal process, when I was buying things in Grand Junction, Colorado in 1985, there was no taker in sight. The only comp was my comp, 10 grand for whatever. And in other words, but that, if you had 3 of them, that was the appraisal number. And in Moreno Valley, 2-bedroom houses that were going for 300 had company, and the appraiser had all the evidence that that was the right decision. And the truth is, I think that's what, Sean, what you're talking about is reconsidering the definition of market value to have some other factor that doesn't let that out of control happen.
Up or down.
Yeah.
I think it would give us
I don't care
stability
about
that would
the
allow
downside.
lending
Now, come
to
on.
be, stability that would allow lending to be a lot more sane in the rest over the long haul. I think it changes the whole game. But
If you
gotta figure it out.
consider what it produces in cash flow. Okay.
If I was to say what I would like to see a year from now for my members, and that would be clarity on, what we're doing. QRM, are we going to have mortgage interest deduction still? All of the things that are really holding everybody back because they really don't know what the future is. Buyers don't know whether they're going to be able to still write off the interest on a loan. They don't know, whether they're going to have to put 20% down or 10% down or 5% down. There's so many unknowns out there that everybody feels like, they're in quicksand. And so I think having some stability from a regulatory standpoint would go a long ways towards making it better for our industry.
Okay.
Well, within the context of the American political system, the aftermath of bubbles is always predictable. It's the collective punishment of the innocent. And we had Sarbanes-Oxley after the dot-com crash, which is the Accountants Full Employment Act. And this time we have this over-regulation across the board.
Yep.
It needs to be counter-cyclical. And so at a point like this, we need to, as quickly as possible, regain a clear, consistent, an unencumbered relationship between buyer and seller.
Right.
We have 1 minute left. We did good. Here's my wish. It hasn't got anything to do with real estate, but in a way it does. Mm-hmm. I wish that everyone that we elected in any position of public office would set aside whether they're Democrat or Republican and become American for 1 year so we could get a lot of this resolved. Thank you, Bill Tan, for making my voice last. I appreciate that. Thank you all so much for coming and sharing this evening with us. This has been an awesome panel. Can we give them a round of applause?
Yeah, you too. Great. Fun.
Thank you, guys. Have a safe night.